Hi guys, Whitney here, and I'm the Director of Investor Education here at passiveinvesting.com. And I'm so happy to present to you another video on our How to Invest in Passive Real Estate series, where we teach you how to build passive income and long-term wealth through passive real estate investments. So I do this series because maybe you've tried to invest passively before, but just couldn't quite get comfortable making the investment. Or you've actually invested in a deal before and realized, oops, I made a mistake. Or you're just so overwhelmed by all the information out there that you just don't even know how to get started. Like, what does everything mean? Anyways, in this series, I help you, the investor, learn the biggest myths that investors have around passive investing that keep them sidelined. I also help you learn the different terms, pros, cons, and even math around passive investing so you can avoid making costly mistakes. And I help you put all this knowledge into action so you can confidently make your first or next investment. So let's go ahead and crush a couple of myths right now. And the first myth is that investors tell themselves, I can't invest passively because I have no control of the investment. That just simply isn't possible for me. Well, I got a little question for you. Do you have control of your investing in publicly traded security? Are you able to interview all of the members of the board that run the company? Are you able to talk to the fund manager that runs the actual mutual fund? Most people answer no to those questions. Here in passive investing, you actually have an immense amount of control before you even make an investment, because you get to decide on the specific real estate strategy that you want to go into. You get to vet operators that actually run that particular strategy, okay, that are pros and have expertise in that strategy. You get to actually underwrite the markets that you're going to invest in, and even the individual deals that you're going to go into. Okay, so there is an immense amount of control when it comes to passive investing. Now, yes, you are giving up day-to-day operational control to the operations team, the operator of the passive investment. But again, you have so many more decisions to make beforehand. The second myth that investors tell themselves is that I won't make that high of a return. Well, we will show you that you can actually make a good return, a really great return on your investment in cash flow as well as appreciation, but also an immense amount of return on your time. So I still have several active investments that I manage, and I probably spend, 15 to 20 hours a month doing that. Doesn't seem like much, but I'm in over 38 passive real estate deals, and I probably spend less than 10 hours a year looking at all those different financial statements and updates. So you tell me which one actually yields a higher amount of return. And that is the reason why I invest passively, is because I get to dump all that time back into the people and the things that I love doing most. And this is the whole reason why I invest passively. So I can spend time with my family, traveling the world, and creating an impact for others. But it didn't always used to be like that. I started off investing in 2002 actively, living, flipping, and house hacking, and did pretty well building up buckets of equity, but didn't understand how to take that active income that I was making from my real estate and transition it into passive income that came in like clockwork every single month and could actually help me unlock those golden handcuffs and free up my time. And it took years to figure all this out. And I had to go through actually the whole progression of buying single family homes and scaling a large real estate portfolio that way before my husband and I just finally smacked ourselves in the head one day. We're like, oh, passive investing, that is what this is. And this is the power it can generate for us. And fast forward today, we have more than 6,300 units under partnership on the multifamily side, and 1,400 self-storage units under management. But these are all vanity metrics. What this has allowed us to do is given us 100% choice and freedom in how we spend our time. Now, we are not the type of people that are going to go lay on the beach and drink a margarita or a Mai Tai anywhere, but we get to step into the things that we love doing on a day-to-day basis. And we can help you do that here at passiveinvesting.com. We have grown a portfolio of $742 million of real estate under management, 4,200 units, multifamily units under management. We also have our self-storage portfolio as well in our note portfolio. But what I get to do here on a daily basis is work with you guys, our happy investors. Now, this video series is for education only. We do go over some finance, legal, and tax information potentially within the video, but this is not advice. I need you to take this information back to your team and consult with them before you go into your next investment. All right, so today let's tackle the different classes of multifamily. What does this all mean? Now, what is an asset class? Let's first, define what that is. Now, when I talk about asset class, somebody might go, oh, are you talking about multifamily, self-storage, residential assisted living? And we're specifically talking about multifamily. And when we say asset class of multifamily, we're generally referring to kind of the build grade and the build age of that building. Now, I'm going to start off with two classes. Class A. Now, here is one of our beautiful properties. This one is in Mooresville, North Carolina, but this is a typical Class A suburban property that we invest in. But there is another Class A level, which is urban luxury. And both urban luxury and suburban, are about 10 years old. Okay, they're generally newer buildings. Now, Class A luxury urban is going to be more upscale apartment buildings in the urban central centers, okay, in the urban markets, and they're high-end grade communities. Now, think of this. The rents on these buildings are probably like $3,000, $4,000, $5,000 a month or more. Now, what we specialize in here at passiveinvesting.com is actually Class A suburban. Okay, these are buildings that are 10 years of age or less, and they're newer buildings, but they're in suburban markets. Okay, they're outside of the city centers, and the average rent on these units are about $1,500. Okay, and when you look at our average household income of the person that's living in the units, this is well under a third of that income, okay? Because their household income is probably north of $100,000. So $1,500 is our annual income $100,000, and so the monthly income of $1,500 is really not going to break the bank. Now, there's also two other classes. Now we're going to go through pros and cons here in a second. I'm just defining the classes. Class B are generally buildings that are between 10 to 25 years of age and are pretty well maintained. Okay. Now this is a picture of another one of our buildings that's Class B. This is our Braxton Cary Weston building in Cary, North Carolina. So as you can see, these are like nice buildings. Like I would live there if I was looking for a multifamily unit. Then we have a Class C multifamily asset. Okay, and these are generally buildings that are built about 30 to 40 years ago. Okay, so different look and feel of the property. They're affordable, but they actually come with a different business plan, and we're going to talk about that here in a second. So I'm not even going to touch the Class A luxury building, okay? Because those guys, those Class A, luxury urban buildings, they have a lot of potential business plan risk with them in a downturn. Okay, so those guys tend to get vacated, in a heavy downturn, as we saw during COVID, the early parts of COVID. We also saw that in 2008. Okay, but Class A suburban, okay, this type of strategy, this building, it's typically a hold strategy. Okay, this class doesn't really get vacated at all in a downturn. Okay, it holds up very well. And the reason is because the average rents are high, okay, but they're not unaffordable for people. Again, like if the average household income is $100,000 and that average rent is $1,500 on the unit, they can actually afford to live in the property and, pretty nicely. They're, again, very well located. They're in a desirable geographic area. Typically we see renters that are white collar workers, and they're usually just renters by choice. Okay, that's what they want to do. Okay, maybe they are living there just for like a year or two, or they just like having, again, outsourcing all of their housing maintenance to a landlord. Okay, with these particular properties, we can also potentially add additional streams of income, okay? Like valet trash or fiber internet on the property, maybe storage lockers, package lockers, maybe we can add additional amenities to the property and charge an amenity fee. Maybe there's covered parking that we can better utilize. So there's additional streams of income that we can generate here. And we get stable income on the properties, okay? And it's an often actually not really that low, but I have to call it low compared to like whenever you're getting like into a Class C development. All right, now they do come potential disadvantages, okay? There's potentially less of an opportunity to move rents. Right now, though, we are seeing rents grow significantly in a lot of markets. So that's not necessarily the case right now, but in a normal growth cycle, the rents are generally at market. Okay. There's also less of an opportunity to decrease expenses on the property because the expenses on the property are already really super low. Okay. When you combine all this together, we tend to get modest cash flow and modest appreciation in the asset, but they hold up very well. Next, we've got the Class B value add, okay? Again, with this, there's a lot of advantages to it. You have workforce housing, affordable rents. You tend to see middle-class residents, okay, a mixture of white collar and blue worker. They're well situated, and they're in short supply, okay? It's not, if a developer can build a building, they're probably going to err more towards the Class A suburban building, okay? Because they're actually going to get a better return when they exit and hand it off to the next investment group. Okay, so we actually see a lot of these in pretty short supply. Now, with the Class B value add, you will actually have more opportunity to pull all three net operating income levers. So a little bit more opportunity to increase the income, decrease expenses, and add additional streams of income. Now, they do come with some disadvantages. We need to make sure that building is in a submarket, that a market and a submarket that are in the path of progress, okay? So that it's well located, okay? We also need to make sure the tenant base is well underwritten, okay? We're looking at a mixture between white and blue collar workers. We just went through the COVID pandemic, and that was one thing, our tenant base is largely white collar workers. And so our buildings were largely tenant proof going through this type of downturn. Okay, so you want to make sure that you're underwriting the tenant base whenever you're acquiring these type of properties. You have to keep them updated to keep up with the competition, okay? You can't have two buildings across the street from each other and one have like luxury plank vinyl flooring, granite countertops, brushed nickel, finishes, and then the other one, same vintage, and they still have, dated carpet, dated countertops, and dated light fixtures. Okay, you have to keep them updated. And when you combine all of this together with the value add B class, you do have business plan risk. Okay, now these are risks that can be mitigated. And groups are very well at mitigating these risks, but you tend to have a little bit more business plan risk, parts of the business plan that there can be a little bit of error. But these buildings hold up, again, really well. If you check all these boxes and you mitigate these disadvantages, you can see pretty stable cash flow and appreciation from these. Then you have your Class C, and I call these more development deals because you need to, again, really buy it right, but you're probably doing a lot of updating, okay? Significant amount of updating, probably dealing with some obsolescence here in order to get that building up to snuff and realize the cash flow and appreciation that you really, truly want. Now, the key to this strategy is to make it an advantage and buy a Class C building in a Class B area, okay? Because we want to, part of the business plan is to shift the tenant base, okay? So, when you purchase a Class B building, the current tenant base is probably going to be blue collar to low to moderate income residents, okay? Or they're just residents who are just starting off in life. They're looking to get a better job, work their way up the rental scale, okay? But when you actually complete that shift to the Class Class C building and Class B area, you can also shift the tenant base. Okay, but again, that's a huge business plan risk. Um, and there's more opportunity to pull all three net operating income levers, but counterbalance that, you get a larger business plan risk, because when you look to do those rehabs on the property, you need to watch out for obsolescence, water and sewer, roof issues, foundation issues. I'm invested in a Class C building, and the operator did an amazing job of navigating that investment. However, there was a surprise with the sewer line when we acquired that building. Okay. So those are the type of surprises you get to deal with on Class C investments. Just like a Class B investment, you want to make sure that market and submarket are in the path of progress, okay? That those areas are being revitalized and that the city is pouring money into those areas. And you also want to make sure that you're underwriting the tenant base, all right? Class C tends to see more economic vacancy. So you can have physical occupancy of the building where somebody is actually living in the unit or not, okay? And on top of that, you can have economic vacancy, just because somebody can be living in the unit but not able to pay rent. And you may or may not be able to evict them for various reasons. And if you have somebody living in the unit and unable to pay, and you can't move them out, either immediately or for a period of time, now you have economic vacancy. And these type of buildings tend to see more economic vacancy. And it's just plain harder. Even if you get a Class C building in a Class B area, it's just plain harder, even once the business plan is done, to compete with a Class B building. But if you can do it well, then you can probably expect to see higher cash flows and higher appreciation on these type of assets. All right, guys, we went through the three classes of assets: Class A, Class A Suburban, Class B, and Class C. I thank you so much for being here with me today. If you are looking to build out your portfolio passively, jump on over to passiveinvestingwithwhitney.com. Here, I can help you get plugged into various resources to help you launch your passive investing portfolio or even grow it. I can help you get connected with some passive investing deal flow, as well as if you just want to have access to our free resources and hop on a phone call with me. You can do that all right here at passiveinvestingwithwhitney.com. Thank you so much for joining with me today, and I look forward to speaking to you soon.